I could see mid to high single digit returns for next year. And again, I think it just all depends on how, I shouldn't say quickly, but how the administration is able to, put their changes in place and how fastly they're able to sort of get their agenda initiatives running.
Welcome to a Wiser Retirement Podcast. Are you curious about how to navigate the stock market in 2025? I'm Casey Smith. Today I'm joined by the king of data, Andrew Pratt. Each week we bring you practical advice on retirement investing and planning for your financial future. Let's get started.
Morning,
Andrew,
Casey.
how are you?
Good. How are you?
So we are venturing into 2025 now, and I'm a little concerned, mostly because everything that I'm reading from all the analysts that are important are painting a really rosy picture for 2025.
Rosy. I mean, yes.
And I say this because everyone said 2021 there was going to be a recession, and there was not. Everyone said in 2022 the market would be up 10% easy. It was not.
Right.
So anytime everyone agrees, maybe that's the problem. Obviously, there's always the doomsdayers out there, but you're usually trying to sell gold or a subscription or a fund or something, right? I mean, 2024 was a good year, up double digits, right? So, what's happening for this year? What are some risks that do you think that we're going to have?
Yes. I mean, as you said, 2024, it's been a very solid year. Can't complain about being above 20%, in any given year for the market performance. So, I think some risks that are out there, obviously we have a new administration coming in. So just kind of the uncertainty revolving around, what policies are going to get done and how that's going to sort of change the dynamic in Washington. And then how long will those changes lead to, whether it's economic impact to GDP or, how things will play out. So I think that's definitely a risk and sort of causing some uncertainty to overhang in the markets. Obviously, the markets had very strong performance the past 2 years. So just the fact that, and I will say some of that performance is justified from earnings growth. Earnings growth has, for the most part, kept up and sort of somewhat justify this price appreciation. But just I think a big risk out there is if, companies, especially these Bag 7, these technology companies, if they're not able to kind of continue with their earnings growth, that pace, that there could be sort of a cooling off period. And then, I think just in general, the national debt, I feel like I keep on seeing data points around, X amount of interest is accrued in this period. And just, I think, if there's not a plan to sort of tackle that, at least in the near term, I think ultimately that could just sort of lead to some, contractionary period for the U.S.
So first of all, I'll say we've already gotten phone calls from a few of Wiser's finest, all concerned about political changes and cabinet picks and what the View is saying about economic policy, which I think that's kind of laughable that people would actually listen to the View for their economic news. But
I mean, Whoopi Goldberg or Warren Buffett,
right? So the I guess I'll say really clearly, we don't take a whole lot of stock in all these political fears in relations to markets. And the bottom line is that we know that companies are going to make money,
right?
Whether they're going to have to sludge through regulation in order to do it, or whether or not it's just going to be a little easier. They make money. Companies make money. If they don't make money, guess what? They go out of business.
They find a way.
Right, or they go out of business.
They adjust, they pivot.
Right, exactly. So we've had other conversations too with clients about this top heavy Magnificent Seven. You did some research on that, and I thought it was very interesting. You found that actually we're more diversified now in the S&P 500 that we have been in the past.
Right.
In the past, there's been maybe 3 companies that occupy the top third of the S&P,
Right.
or especially the S&P. Russell 1000, I guess, is a little bit different, has a little different weightings, I guess. But anyway, so what are your expectations for 2025 when it comes to, let's just start with U.S. equities?
Yeah, U.S. equities. And as you mentioned, I guess another concern is that market concentration. That's kind of been topical currently. But yeah, looking at other different, sort of high frothy, concentrated periods. I would say right now, as you mentioned, we are a little bit more diversified, but also too, these companies are, high cash flowing companies, very profitable. If you just compare, now to, 2000, the tech bubble, I think it's about 50% higher today in profitability, from return on equity, from profit margin. So, yes, we are concentrated, and also too, valuations aren't they're high, but they're not as high as they were then. So it's something to take note of, but to me, it's not, a huge concern at the moment. But, looking out for 2025, I was looking at the Wall Street analysts kind of forecasts, for earnings growth and for S&P 500 price targets. It's kind of interesting. So today, evaluate the forward valuation, which is just, price over expected earnings multiple, is about 24 times. That's a little bit higher than history. But, going back to these analyst forecasts, they're expecting about a 13%. The median average, or the median, is about a 13% earnings growth for next year. And it's also, the median is also about a 13% price target. So if that were to hold true, then that wouldn't really change the valuation multiple that much. So that 13% price target implies about a 6,600 price level on the S&P 500 index. So about 800 points above where we are today. Again, so I think that's kind of, I would say it's maybe a little optimistic. But I could still see us doing about, I think Goldman Sachs had a good research report, and their expectation was about 8%. So, I think I could see mid to high single digit returns for next year. And again, I think it just all depends on how, I shouldn't say quickly, but how the administration is able to, put their changes in place, and how fastly they're able to sort of get their agenda initiatives running.
Well, that's a good point. I guess I'm trying to pull politics out of the conversation, but we'll put it back in. We have in what tech world be A and B testing. So we've had an A test of the Trump administration. We had a B test of the Biden administration. We had a choice of continuing Biden's policies or changing back to Trump policies. Overwhelmingly, voters said Trump. So could we not go back to what happened the first 3 years, which are normal? COVID year was not normal. We go back to the first 3 years and understand what tariffs did with the stock market, what some of the lowering taxes did to the stock market. I believe in the end, it was all favorable. I remember that we had to bail out some farmers. I believe we had to help U.S. Steel a little bit, maybe. But in the end, those were all very positive years for the stock market. So there ought to be tailwinds ahead, I would think, because the Trump administration should be pro business, publicly traded business specifically. And I guess one thing I'll add is, unlike other presidents that you typically say, yeah, we don't control the stock market because they just don't understand it. He would step out and say, you see what the stock market did today? I did that. and probably he didn't actually, but he seems to pay more attention to that than other presidents, from what I remember.
Yeah. And I think we're going to have a podcast on this. So I don't want to get too in the weeds here, because I think people are still sort of digging deep and putting thoughtful analysis together on this. But yeah, I will say, Trump is very, he references the stock market a lot and his 401k. I can't tell you how many times he's talked about that.
Right.
But I do think, it's a benchmark for his success. And I think he would pivot if things weren't going the way, or if the market didn't
If the
react
market was selling off favorably, he would find a way to change policies to get those positive results.
Yeah, and I know it's not as easy just to quickly pivot, but I think there's going to be probably just some conflicting forces here. Yes, tariffs might increase inflation, but from everything I've seen so far, it's like a one-time inflation bump, and it's not going to bring inflation back to 7%.
But it didn't cause inflation last time.
Yeah, it might be like a one-time, like, I don't want to use the word transitory,
right,
but it might be like a one-time effect. And from what I've seen, it would be like 0.2% or 0.3, like very minimal that could, easily kind of pass through. And then, yes, there should be additional tax cuts for consumers and corporations that obviously should help consumption, which, GDP is mostly comprised of the consumer and consumption. So, yeah, I think there'll be some conflicting forces here.
I can see why inflation would be concerned, though, because if you don't tax overtime, you don't tax waitresses' tips, right? And you, at the same time, you want interest rates to be lower. Home rates come down. People have more money now. I could see that being a good thing, but at the same time, people do need more money.
Right.
There's people who make less than $100,000 a year. They feel very squeezed. I'd say probably less than 200,000 a year feel squeezed.
Yeah. I do kind of feel bad for the younger generation. But because especially on the home purchase side, because, everyone was hoping that mortgage rates would come down, and they just haven't. And that's really because mortgage rates are tied more to the longer end of the U.S. interest rate curve, like the 30-year.
Yeah.
But or in the 10-year. But I think hopefully there'll be some flexibility on that front. But also too, I think the majority of homeowners, the reason why the economy has done so well is their personal balance sheets are actually in a lot better shape now than they were back in 2008, because a lot of them have locked in these low interest rates, and they're able, yes, while, credit card delinquencies are ticking up, auto, delinquencies are ticking up. Overall, their net worth has increased. So, and yes, that's not necessarily a good thing, but, from a net worth standpoint and a personal balance sheet standpoint, they're actually in a lot better shape now than they were 15 years ago.
So what are you seeing out there that would be negative, meaning maybe reports that you've read or people concerned over the next 12 months, which is a very short time? We don't even focus on 12-month returns. We're focused on 5+ year returns. But what are you seeing over this next year that you think could be, reversing our fate as far as market performance goes?
Yeah, I think, really, again, the national debt to me is a little,
but in the national debt more of like a 10-year concern at this point?
Yeah, but I think, now that the interest payments are very high, it is more a little bit longer term. I agree. I think that's something that could just kind of more, weigh on Congress more a little bit over the next 12 months. I would say, a little bit about the commercial real estate, refinancing, especially now. I mean, I think, Fed fund rate cut expectations have been lowered lately, and, these smaller businesses aren't able to kind of, I think some of the smaller businesses were hoping that they would get a little bit more relief on the floating interest rate, on those interest rates. But now if they're not able to sort of withstand a higher rate, if that were to happen, that could be a concern. And so I think that's probably one of the main concerns that I have.
So just commercial real estate?
Commercial real estate and small businesses and like smaller cap stocks, if they're not able to withstand these higher interest rates, if that were to play out.
Yeah. What about, how do you think of war? Because we've got two wars in particular brewing that could go out. I guess that doesn't really affect us unless It affects national debt, obviously, but wouldn't really affect the stock market so much.
Yeah, unless it's like a, unprecedented type of world war. There's always geopolitical conflicts out there. To me, it seems like tensions have been easing with, Ukraine and Russia somewhat. Hopefully, those could continue. So I feel like there's always, catalysts overseas that are, and thankfully, even though some of the revenue in the S&P 500 companies are coming from overseas, these companies are largely insulated from those conflicts. So, as far as the market performance, there might be some short-term corrections and pullbacks, but I think overall it shouldn't really, deter or sort of just throw off the trajectory of the market growth. But yeah, unless it's something like major.
I guess that's true. The key players in the wars right now make up less than 1/20% of the total portfolio.
Right.
So it would have to really get out of hand for that. It probably, if anything, it would affect the international side of the portfolio more. You already saw that with increased natural resource prices, gasoline, things like that in Europe, which affects them. We have a very underweight allocation to international.
Right.
Do you see international getting better next year? Every year, the outperforming asset class is supposed to be international, and every year it's pretty much not.
No, it's everyone, always touts that or says that international is cheap, but maybe it's cheap for a reason. And it's been cheap relative to the US market for a long time. We're underweight international versus our peers and most large institutions on the equity side.
Right.
It's still important to have in the portfolio because it does add diversification benefits. You do get exposure to different regions and different types of companies across the world. But really, I don't see it really. I thought a high interest rate environment would be more beneficial to international companies. I could see, and what you're starting to see here in the U.S. too is the yield curve. Some of these sovereign nations' yield curves is starting to uninvert, which means the short end currently is higher than the long end, which is not good for capital markets. I could see, when it uninverts, that means the short end, decreases on the, lower to the longer end. I could see like if that were to continue to happen and it's a more normal type yield curve, which is very beneficial to capital markets, that actually, international could potentially outperform because they're more heavily weighted in financials. Like I think they're, just ex-US exposure. They have like about 2.5 times the financial stock exposure that we do in the S&P 500. So that could be one way where international could have a little bit of outperformance, but overall, I really don't see the dollar, weakening over the next 12 months. That's not really good for international. It's not really the best for multinational companies, the S&P 500, but it hurts international more. So because of that, I really don't see international outperforming US.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
You still keep it in the portfolio for diversification, and just because we think one thing doesn't mean it flips overnight, right? So,
well, yeah, and international, they had a slight outperformance, I think, in Q3. So again, like we want exposures to all different areas in the global marketplace, and that's to help sort of insulate portfolios when these other type of exposures outperform, and we can't predict that.
When you think about bonds, bonds have been kind of on a wild ride the last few years,
Yes.
starting in 2022. With the Fed's cutting rates, when that happens, bond yields are going to decline, but the value of the bond goes up. Correct. So any reason why we have to be owning bonds and portfolios in 2025?
Definitely. Again, it all depends on your risk tolerance, and for those clients that are more risk averse and that are in their distribution phase and retirement, that don't really, it's not necessary for them to take on that volatility or the extra risk. Bonds are very important. They provide insulation from these down markets, and especially when you're drawing on your portfolio to fund retirement expenses and needs, you want that buffer in your portfolio. And also, you don't want to sell equities at the worst time because they can bounce back sharply. So bonds, a few things that we would do, especially with investors that hold more diversified portfolios with bonds, is if there are pullbacks, we could always rebalance and look to rebalance back into equities if bonds became overweight, and also tax loss harvest there too. But it is very important. Bonds are uncorrelated. It helps improve your risk adjusted return and make it a smoother ride for portfolio return over the long term.
Everyone's been waiting for this section: Bitcoin and crypto. So we do have Bitcoin and crypto inside of our portfolios. The max percentage is around 5% for our most aggressive investors. Been a good ride post Trump election. We were early adopters thanks to your leadership. Where do you see crypto, Bitcoin over the next 12 months?
Yeah, so there's just like with S&P 500 forecasts, there's a wide range of forecasts. I think Kathy Wood, who's the CEO of ARK Investment Funds, has a crazy forecast for Bitcoin over the next year. In the millions, but for a lot of price predictions I've seen, especially on the Bitcoin side, I think it's not unreasonable to have a 150,000 price target for next year. And then I would say to even amend that, if the U.S. government does adopt a Bitcoin reserve, I could even see that almost doubling to even 300,000. I've seen things, a very respectable person in the industry say even up to 500,000 next year. I don't want to go too rosy on that, but
it's still the most volatile asset class you could own right now.
It is,
outside of a loan to your brother-in-law.
True.
So it's you have to use it in very small doses in the portfolio.
Yeah,
but
definitely.
I tell people, I think it's a great investment. Put a little bit in, close your eyes, wait 10 years.
Yeah. And that's important. It's a long-term hold. And, I think, especially since the election results, the crypto asset class has just been hammered and with regulation. It just has not been an easy road for the industry as a whole because of regulation. And I think,
well, I don't think it's been hammered with regulation. I think the SEC has doing things with no regulations. The problem, there's no regulation.
Yeah, there's no framework.
But at every turn and point, they've been attacked.
Right.
Whether it be by Congress or certain people in Congress or by the former SEC chair. It's been a very big uphill battle with very little guidance.
Yeah, that's probably a better way to say it.
That's been the problem.
But yeah, I think, some of the optimism is around, more favorable, or, less restrictive stance on the industry and more open to adoption and being part of the U.S. government, currency framework or asset mix framework. But yeah, I think just in general, just for corporations too. And, I've seen a prediction out there, like there's going to be anticipation of a lot of crypto related companies IPOing next year. So yeah, I think it's, there should be tailwinds from that. And then, obviously we won't necessarily get into it, but there's a lot of good positive supply demand, economics for Bitcoin in general.
That again, some people go, I don't understand it. I'm not going to invest in it. And that's not a bad philosophy.
Right.
If you don't understand something, you definitely shouldn't should invest in it. But we've led a few families. About 15% of our client base seem to be investing in that. I will say, picking. I don't know if it's going to be a 2025 theme or not. I think it's over the next 3 to 4 years. But watching development of AI and now quantum computing, which I didn't really think I'd know anything about, but after a few podcasts, a few white papers, I feel like, oh man, I should I should have gone to Georgia Tech like you. I should have majored in quantum engineering.
I wonder if that's going to be a degree in the next year or two.
Right. Yeah, there are classes. I didn't know if there was a major or not, but and then nuclear energy obviously is back and being debated. China's having some, I guess, more smaller nuclear type facilities built, and here we're more about the big nuclear facilities built. I think all of those things, in my mind, lead to more efficiency.
Yes.
And with more efficiency, you're able to do more with less, which means you should have more profits, more revenue, which ought to turn into more taxes, which hopefully helps, if we're good stewards of that revenue, hopefully helps solve our long-term problems.
Yeah.
What I don't subscribe to is this, we're going to hit this, 50, 60% tax bracket in the future because we have to be able to afford these payments. I think people are missing these big themes that are happening in the US right now, really the world too. But
yeah, and that's one thing we didn't talk about with the S&P 500 is profitability. And another reason why we've, sort of gone up and to the right is profitability profit margins are near their highest level in the past 20 years. I think we're close again to about 13%, and the 20-year average is, a lot lower, around, well, I shouldn't say a lot, but relatively a lot lower, 10 to 11%. So, and I think these companies have been a beneficiary of AI and synergies created by, reduced costs because of that.
Yeah. And I don't know that people are really measuring that. Well, I mean, I guess they are because the market's up, right? So somebody is. Some very smart people are doing that. You talked about risk earlier, national debt. I mentioned maybe war creeping in. I think inflation could be another issue if we keep giving out free stuff. Not really free stuff, but giving breaks. The people who need breaks, they're probably going to spend the money. They're not going to save the money. At the same time, we have the highest credit card debt we've ever had as a country. That's coming right out of COVID, where it became the lowest. People have very much lived day to day, don't they?
Right.
From saving a ton of money to, I can spend money now, and you just let them spend money.
Yeah. Mm-hmm.
So that's concerning to me. But personal debt as well as the international debt. When you look at, we'll kind of wrap up with this. When you look at framing our wiser portfolios, so you're now talking to the wiser client base now. But as you're framing these portfolios for this year and beyond, what are you trying? How are you trying to position those?
Yeah. So, in general, we want to frame the portfolio. It's a long-term mindset, and it's really overall, I'd say, I don't want to say market neutral, but just not taking too big of a bet, deviating from like broad market exposures. And what I mean by broad market exposures is like the S&P 500, the US bond market, which is the Barclays aggregate index. And yes, there's maybe some tweaks here and there to get a little bit more exposure. But again, when we make these tweaks, they're also long-term position moves. Like we've had a technology focused fund that gets a little bit more exposure to the technology names. And that's because we are big believers in this space. But there's also, a bond fund, where we think this manager is better to navigate the fluid dynamics of the bond market that an index might not necessarily be able to capture. So it's, we're making some tweaks here and there, but overall it's portfolios that are positioned to capture these broad market exposures at a low cost too.
Yeah. I try to explain to people, is like, we like winning. I hate losing. And really the only way you can lose in investing is if you start doing these themes where you think you're smarter than the market. Mm-hmm. And if you buy the S&P 500 as a core holding, it really is self-healing over time. Right. There are time periods where other strategies would have worked, but they're very short in nature compared to a 20-year time horizon. And it just doesn't make sense to me to make bets to hope to beat an average that only 2% of fund managers beat nationally over a 20-year period. So the value of a financial advisor, I think in the future and now currently, has been in the financial planning. We talk about that with Missy and Shauna, but there is some method to the madness in the asset allocation side. Obviously,
Right.
we're not just buying it and
Mm-hmm.
just setting it and watching it. we do
Yes.
other things, right? Tax loss harvesting, rebalancing, making strategic pivots like with technology or with free cash flow. We have one fund that focuses on markets, on stocks free cash flow. Those are all things that help add value to the portfolio. And then what we give our flat fee clients is just an abbreviated version of that they can implement on
Right.
their own at home or through our Flight Path
Mhm.
program. So it's very interesting to me to see. So we have a database. The database is called Orion. You can look into there and you can see our portfolio performance versus thousands of other firms who also use the Orion accounting platform. It's one of the largest in our business. And we're always in the top quartile. And I always kind of chuckle at that because, like, man, every time I meet another advisor, they have some crazy strategy, and all it is they're spinning their wheels to come out to be less than average every single time.
And
less
then
than
also,
average.
there's firms that are too tactical, like a firm I came from, where they would make under and overweight calls on equity, and you might have the smartest team or economist in the world, preaching that you should go underweight equities at this point, but then turn out to be wrong, and
Right.
and very lag the market.
And then how do you make up for the lag?
Right.
You have to then be really right about something else.
Exactly.
So yeah, it's the same way. Something else I thought I'd mention on the podcast today. You sent me a chart. I actually put it on my LinkedIn. I think it was on my X feed as well. Which my X feed, by the way, is bullish pilot. So, but the I in bullish is actually a 1. So anyway, look me up if you're on X. I don't have many friends on X. Yeah. I just started using it, but I think I posted it there as well. But the chart is the market movements after trading hours versus during trading hours. And for all these people that think that they can, when things get volatile, I'm going to move my money to cash and I'll put it back in later when what they're really telling you is when they feel better because they don't have any economic data supporting one thing or another. But they say the Dow's at 40,000 and it's sold down through 35,000. And they say, well, okay, well, I'm going to sell. But if it goes down, I won't participate in that, but when it comes back up to 35,000, I'm going to buy back in. Well, it was like 90% of the stock market movements are all done at night, meaning that if you're not,
I think it was even higher than that.
Yeah. So it's the open. So when the market opens the next morning, if you sold at 35,000 and the next morning it opens at 36,000, you missed out on 1,000 points.
Right.
And there's no way to get that back. There's no way you could really buy that either, unless you're into the futures market. And no one at home. No. If you're running scared, you probably don't have a future strategy in your back pocket.
You're probably not hedging with
futures. They don't talk about that on the View. So yeah, it's just the buy and hold game is just way undervalued. And when things get volatile, that's why you have bonds in your portfolio. That's why you have 2 years or 3 years worth of cash in reserve for your expenses. So you don't have to talk to an irrational market. You can step away and just kind of let it all settle out. The worst case scenario is it takes a couple of years for it to come back, but no more than 2 historically. So anyway, well, Andrew, thank you for this and the outlook. I don't think we got too many hard predictions in that, but this is not what we do.
No,
we're not going to pick a sector that we like. We're not picking a fund that we like. We're simply just kind of looking at across the landscape going, is there anything that we need to navigate away from? Or is there any small tweaks in the portfolios that we can make to be able to make sure we're achieving market-like returns or slightly higher? You're doing a good job of that. So thank you for taking care of us.
Yep, no problem.
All right. Thanks for listening to this episode. We have a few other episodes talking about index funds and strategies and benefits, episode 235. Also, talking about investing for the long haul. That's episode 182 from a while ago. We also have a YouTube channel, A Wiser Retirement. Tips for investing when you have variable income, and does lump sum investing beat dollar cost averaging? That's one of my favorite little pieces there on YouTube. A couple of charts for you as well, talking about sector performance over presidential elections. That'll be in the show notes, as well as earnings estimates for quarter 4 2024 and onwards. Thanks for listening, and we'll see you guys next week.